We've been talking about there's so many cross currents at the moment that investors have to contend with. What do you make of it all?
Well, I think the key here is that a lot of the key themes that we had in the first half of the year has yet to play out. For example, the slowdown in the U.S. economy, the recovery in the Chinese economy, and also the peak of the interest rate cycle, which we do think that we're approaching the end, whether it's the Fed or even some of the more developed markets. I think we've reached that point for Asian central banks. So I think it's a bit more, we need a bit more patience for the economic data to roll over, both in terms of the U.S. for more moderation, and hopefully we see a bit more specific stimulus coming through from China that not only help the Chinese markets, but also the broader Asia markets who are dependent on the Chinese economy. Yeah,
particularly when it comes to that broader trade pulse, right? So if you're patiently positioning your portfolio for some of that to finally come to fruition, what does that look like?
Well, I think we still put quite a bit of emphasis on fixed income, partly because you do generate income while you wait. If you look at equities, we do think that a globally diversified portfolio in both developed markets and emerging markets makes sense. But I think from an equity fixed income allocation perspective, we still think that fixed income has a lot to offer, especially with the recent correction in the treasury market. Yields has gone up a little bit. I think as we approach the peak of the hiking cycle, this does call for a really good opportunity to lock in some of those high rates, whether it's in government bonds or even further down the credit rating, whether it's in investment grade, even into the high yield market in the U.S. So I think we'll start with the fixed income markets, and then we can look into equities by markets as well as by different sectors.
Japanese equities have been favored by investors lately, but what does it mean when you have that tweak in the Bank of Japan's yield curve control program?
Well, I think the impact from the yield curve control program is quite limited for the Japanese market as of now, because a lot of the rally that we've seen in Japan is for two reasons. One is the macroeconomic recovery that we've seen in the Japanese economy as a result of the coming out of the COVID pandemic, but also more importantly, some of the corporate governance changes that we've seen accelerated in the past 6-12 months have added to that momentum. So I think if you look at the style we've seen in Japan this year, it's more of a value rally rather than a growth rally. So even if the BOJ does tweak its monetary policy, I don't think that's going to curb enthusiasm on the Japanese market for now. But obviously, as and when the Japanese economy continues to gather momentum, and also the global economy as well, we might want to start to focus a bit more on the growth sectors where a lot of the Japanese companies have very strong international competitiveness, very strong intellectual properties that can benefit from the eventual recovery of the global economy, perhaps in 2024.